vendors, giving us like the most scalable and easy plug-and-play solution for buildings, from office, residential, co-working, co-living. It's allowed us to easily scale across Europe. We're a European company, so most of our footprints in Europe, and now we're launching here in the US. And this is all great, and with all this we can start getting the data on users, right? And with data on users you can start thinking about how you can better curate services offerings within buildings, but not only within buildings, kind of perhaps like the block around you. And so generally, PropTech I think is moving towards a more consumer-focused approach. So happy to be here and kind of bring more of that consumer mindset to this panel.
Great, thanks James. Let's just pick up with you, Carsten.
My name is Carsten Loll. I'm real estate partner at Linklaters in Frankfurt and Munich. Thank you, Richard, for kind of having the energy to kick this off again, because in my previous 2.5 years that I have been in New York, in my previous position as co-head of DLA Pipers practice, we did the same thing. It is, and you saw that from that bubble, it is still the by far largest real estate market in the world. So it is something that we Europeans shouldn't miss. And I advised Union at that time to enter the US market, and so that at breakfast, the first asset they got offered in the US was in Houston, Texas. That's not what they wanted. But my former colleagues advised them, look, it's at least a good asset, buy it and make your mark in the market. And so they did, and they have now 6 billion assets under management. So I think it can be a success story in this way or the other way. So thank you, Richard, that we try to kind of push this and give you and others a platform here to see what we're doing in good old Europe. So.
Good, Guillaume.
Hello everyone, my name is Guillaume. I got my own company, basically doing the same kind of business that Alexander is doing, but mainly focusing, I would say, on family office and fringe institutional. So basically what it means is like family office that are so big that they need that kind of corporate approach, and they wouldn't partner with large global asset managers of the world because they wouldn't be fat enough to provide large mandates. So basically acting the role of a pathfinder for mainly overseas family office, and currently working with one large American firm and one large Lebanese family office, and basically looking at value add products over Europe, mainly focusing on cities, so London, Paris, I would say top 10 German cities, and potentially also having some foray in Southern Europe with a lot of precaution, but we'll talk more into this, I'm sure, within about.
Okay, good. And again, if there's questions you've got, just raise your hand or shout them out, whatever it is. The session is designed for you guys as well, so if you've got any questions, don't wait for me to catch your eye, because if I'm not looking in the right place, just ask a question. Let's maybe just pick up with you, Carsten, in terms of when you're looking at the overall market at the moment and the clients who are beginning to look. I'm not particularly going to deal with capital flows in this session because we'll be able to do that with Zoe. And but what are you seeing in terms of clients? Have you seen clients looking less at Europe at the moment, or having more concerns about Europe based on Brexit, based on some of the other political elements that there are at the moment?
I think we have. It doesn't matter. It's probably okay. Yeah, I think we've seen in our practice, what we've seen in the charts, basically there is the US as a market, and hedging costs, and I discussed with Union yesterday. Hedging costs are enormous, and if you hedge, it is a hindrance. However, it is still the biggest and the most liquid market. So that's the US. Then you have Europe, and within Europe you have London, where you have the problem that you don't know where this ends up, and in terms of currencies. So I see two things with regard to London. Overseas and Asian investors heavily invested to London, so they are not scared, whilst the Europeans, Germans tend to be a bit afraid. I tend to share the view of Alexander that there's good opportunities out there. Most likely in the West End in my eyes, because it is the safest place in London. I wouldn't possibly go for Canary Wharf with all the banks. That might be a bit tricky. And then there's Paris, which kind of saw an upturn again. However, politics are a bit uncertain. I'm not into politics. I think that doesn't have a big impact on the markets on the long run, but still there's discussions. Then there's the small countries, the Nordics, but they are really small and local markets actually. And then there's Germany, and people and our clients tell us, yes, we want to invest, we want to invest more, it's just so expensive. And you've seen that 2.5 in Munich, it is crazy. And even if you're willing to accept that, there's no product. So it is, we see, and it was a record year last year, so we see strong interest. However, it is getting more and more difficult to find the right product. So you need to have the feet on the ground to find it. Basically, so it is basically domestic players to a vast majority, some Asian money, some US money, and you see the big players we will talk later about. Did a lot of deals with Blackstone, so they are big, and also Brookfield. So you see how things develop. And yes, for the rest, Spain for opportunistic investors, but small markets. Then Lisbon, but a really small market. Milan, and then basically that's it. Poland. So Europe isn't easy. It's there, and strong interest in Germany.
Okay, good. Maybe just deal because one of the risks that's been discussed quite a lot, particularly in Europe and I guess also here, which is that you've got a changeover in terms of politics at the top, with Merkel having been there for such a huge amount of time, now stepping back. Does that introduce risks, whether you believe them genuinely? Do you think there are genuine risks associated to that, or do you think that's just concern from outside, and is that reflected in your clients' also concerns about Germany or not?
I would say it's a German boring politics, so I think it has no big impact on the market. And whether it's, you probably will never be able to pronounce Karrenbauer, I'm not either. So whether she will be the chancellor or not, it won't change much. Yes, there is that AfD, the right-wing party, which is the sentiment that you see in all other countries all over the world. But it's still, in relative terms, okay. It's 12%. It is. It's not nice to see it in my eyes, but it won't change the markets. So I think we're fine. Okay, good. And Guillaume, given that you're the French person here on the panel, explain the Gilets jaunes. Macron was obviously the darling of everybody until recently. But do you think that's more than just a political issue? Do you think that's actually going to make a significant impact on investment into France at the moment? Do you think that's changed the views? Has it changed the views of the investors you're talking to as well?
It's a good question, because from a French perspective, and we had that discussion when we were having the breakfast here, is, it's business as usual. Obviously, I think the main problem is about the media that are, putting on the loop all those pictures when you see crazy people destroying, government property on the streets, etc. But it's just a small proportion of the population, and basically, last November it was pretty hectic because no one really foresee that. But those kind of protests were silent for decades. Nothing has changed. We know what the problem is that the French government is not doing enough to basically do the reform that Portugal or Greece has been doing, because they can keep on borrowing and the indebtedness is just going on. That's the real matter. So I would say, honestly, from a pure business perspective, Europe and this it doesn't change anything. The funny thing is, I mainly work, as you may know, for some in the room, with two clients, so one from the Middle East and one from the US. And basically, from an American perspective, when you can price a risk, it's easy. It's mainly it's one, maybe it's half of it, maybe it's double, I don't know, but I can price it. But when it comes to social, so when you can see some crazy French people around in the street, and obviously because it'd be the European news or the American news, and I suspect that Fox News is going to be playing it all the time. they were calling me and saying, what's happening? Are you safe? And yeah, I'm safe. I just went and played tennis with my family. There's no problems. It's crazy. So we should stop investing in France. What do you think? He said, it's just 2 blocks maybe from Palais de l'Élysée, which is like the White House. There's been some trouble, but it's been contained. It's just every Saturday kind of thing. So it's funny because I would say that the value add window for the last maybe 2 months have been given a lot of opportunity to non-American value add players, because when it comes to I would say social risk, it's really hard to I would say from a non-European perspective to assess that risk. But business as usual. It's nothing has really changed.
Okay, good. Just interestingly, over the last 2 years since the referendum, there has only been one session where Brexit was not mentioned at all, and I had to avoid myself from saying it because there was only about a minute to go, and I thought if I say Brexit hasn't been mentioned, then it would have been mentioned. But so it's been a constant in all of it. And just to reflect the dilemma, we've got Alexander there, who is pro-Brexit, me, who's against Brexit, and also to reflect the current polling, I've put on. Alexander has obviously stayed broadly in the same shape since December, whereas I've put on a little bit of weight over Christmas. So we're reflecting the polling as well at the moment. Alexander, give your sense of your perspective on it and what it, in your sense, what that might mean.
Okay, thank you. That's a very short question. Let's take a step back. I think the decision of the British people to step away from the European Commission was one that the Americans will very well understand. I recall in your history, no taxation without representation. That's a famous word, and that's why I found it amusing that one of your former presidents tried to steer in the opposite direction. The European Commission is run very much by the French, in a French model, in a very centralistic way, which doesn't suit more independent-minded nations. The Germans are happy with this. You can hear from my accent, I grew up there. Anglo-Saxons tend to be more independent-minded and want to have a little bit more control and interaction about their own destiny. And this is what the European Commission tried to force on Britain, be it the European Court of Human Rights, overruling a centuries-old jurisdiction, a parliament that the Brits would say is interestingly made up, overruling our parliament that has been active since the 12th century and has done a reasonably good job. So at some point in time they said this is enough, and if you were to look into Italy, I'm not sure whether you'd get a different answer. If you were to look into the Netherlands, they're pragmatic. So it is, Britain has been the only country that's democratic enough to ask its populace, do you really want to stay in this club? And now in the exit conversation, European Commission has made it very difficult and very unfair on the Brits to stay in. First we have to tell you how much we're going to pay, afterwards we're going to discuss which trading relationship we have. It's the same if you go to someone, if a couple gets divorced and the lady says, okay darling, how much are we going to pay me once we settle this? We'll sort out whether I let you see the kids. I mean, that's not really a way to run it. And so there is this process, and it's also not helped by having Mrs. May, who should have taken a lesson from anyone to negotiate, quite frankly. This was not very good. And so this is political risk that's going to manifest itself over the next 2 or 3 years, because that's going to be bumpy. It has a big impact on wider Europe. Britain is one of the biggest importers from the European Union, 280 billion a year net imports. So this is going to hit Germany, potentially France, Italy, very strong. And so we'll see reverberation across. But that shouldn't worry you, because in the end it's a strong nation that has for centuries done very well. And that's why I think it's a buying opportunity. I was very keen on buying in the Netherlands in the financial crisis, because it's a strong, well-organized nation. I was very keen on Dublin Because again, strong trading mercantile nation. If you look at the underlying, and maybe this is true for France and Paris as well, which I don't know as well as Guillaume, don't get too scared about the noise around it. Sometimes a lot of noise is a buying opportunity, and we lost this one deal. And who bought it? A friend of mine who sits in England with overseas money. They took it. They said, yeah, we're happy about the risk. This is not a big issue for us. These 2% extra, 5% versus 3%, will pay a lot of dividends in the future.
Okay, good. I mean, yeah, go ahead, yeah.
So just maybe one word. So I'm not pro-Brexit or anti-Brexit, so I want to share any view here, but just bring up on one of your comments, saying that maybe the European Union was a bit unfair the way they approached the negotiation. But I guess you could recognize, or I could be wrong, but I believe that the British people, that would be in our case, would have reacted exactly the same way. As regards to the negotiation, that is to say, right, you want to leave, then it's your decision, right, but we won't make any favor, which you're right, it's not very nice maybe, but I guess that any country in the world would have reacted the same. Interesting?
I disagree with that. I think there's a spirit of, if you are neighbors, you have to think a little bit further. And we have to understand that Europe should be a club where you can go in and out if you want, and where all the members stay in there because they want to stay. Otherwise, I think the better English word is not club, but probably prison. And it shouldn't be one.
No, sure. I mean,
Let's move on from Brexit. I think this is going to be an interesting topic.
But in terms of markets, I think that is probably what worries me a bit. Is yes, the Commission, and that's politics, but to kind of say that a small bubble on that chart can do better alone is just wrong. So if you look at the overall numbers, Europe together is probably a bit the size of the US, and that makes markets. So I'm a bit scared that this tendency, it's not only in the UK, it's in other countries as well, that the tendency of trade war, borders, blah blah blah, will cause damage to all our economies, and actually that this is a bit something that comes from the past, because if you look at the real numbers who voted in that case for Brexit, but can it mean all other countries, it is basically with a similar thing. I mean, it's a generation that is at the edge of leaving us. So and if you look at the younger generation, it's different. So it is a bit unfair thing to decide on the future on the back of blaming the Commission or whatever. So I think if you see it in pure terms, how the world should be in terms of peace, that's politics, but also in terms of markets, and that's the small bubbles, Europe cannot do alone. Times are long gone.
And just in terms of, yeah, go ahead. Hello, how are you doing?
So, hi. In terms of, do you see investors, pension funds in the UK investing outside the UK because of the uncertainty? Primarily, I would say London investing in New York, as an example.
I'm not a specialist on the flows. I know that the UK pension funds are reasonably active in the UK.
Mm-hmm.
How much they allocate overseas, I don't know. I can't tell you.
Yeah, maybe a quick answer that won't maybe 100% satisfy you is that, and we had a discussion with a couple of people in the room, it's, you know, when you're non-US, it's really easy to get in the US, to invest your money. They welcome you, it's red carpet and everything, but when you want to get the money out, it's really, really hard. So you got to, obviously we have beautiful lawyers all around us, but it's, you know, I was making the quote
It's good,
that
doesn't matter, it's beautiful.
it's a small country, you know, when you sell a building, the tax administration is calling you and saying, well done, congrats for the selling, etc. What are you going to do with your money? And, you know, in Europe, when you sell a building, well, they got so many trouble, you know, doing other things, you know, you can basically turn the money around, you know, a long time. So I would say it's not very convenient for European people to, and especially I would say from UK pension fund to invest in the US. They mainly do in Europe, obviously, because they know it and, you know, it's neighbor kind of investing. But it's really hard for Europeans to invest in the US. Yeah. Honestly, it's the way out that is kind of tricky.
I mean, I think you've definitely had from the sessions that we've been running, you've definitely been having views expressed that some of the capital that would naturally have gone to London, which is slightly maybe shorter term fund money, because there's uncertainty about the horizon of 4 or 5 years, are therefore skipping over that and moving towards Germany or to Paris. And then you've got, yes, sorry.
No, I was just going to ask one process question on Brexit, to be in Britain, but I live here, so I'm not as entwined with it as much. Are we likely to get an extension on Article 50? That's looking increasingly likely, isn't it? Because obviously you're confident in May.
I'm not confident in May, that's my problem. I'm confident in the decision to leave, but the negotiations have been handled in a terrible way, so I can't answer this. And it depends, it takes two sides to tango. If you have an antagonistic side, the Brits said, look, we leave and we continue trading. The other side doesn't want that. It's very difficult to make any deal happen. Every lawyer in the room will tell you if the other side has decided they don't want to give you a decent deal. So I think it's going to be bumpy for a while. And if you watch this space, if you look about thinking to London, you don't have to do something before the end of March. Watch it. It's going to be bumpy for a while, and it may present very nice opportunities. Because in the long run, Carsten is right. The country is too small on its own. It will forge international trade relations, I have no doubt about it. So this argument that it's too small, it's not Greece and it's not Belgium. But the European countries trade with it so intensely, it would be really stupid if they wouldn't come to a trade agreement. And we have this with all other nations. What the Brits said, just because I trade with you doesn't mean half your population can come here. We do the same with America, we do the same with China. If you had an agreement, you trade with China, and all their population can up sticks and come to you tomorrow. That's going to get tight in the country, you know, 1 billion extra homes. You'll have your work cut out. And so I think there is an economically sensible resolution. We just have to get the politicians, and this will be the finance ministers of the countries whose money it is, who get together and say, look, let's keep trading and let's just find a solution.
During that time, US. As well.
But I mean, sorry.
There's two actually. There was a question there as well. Yeah.
I was just going to add that not to flog a dead horse, but the sticking point is really Ireland, because the fight is whether Northern Ireland wants to have a border between itself and the Republic of Ireland, and I find those two positions mutually exclusive, and I think that is why the trade situation, the discussion is hanging up, because how are you going to put the border? They don't want that because they don't want to go back to the Good Friday, renege on the Good Friday Agreement, and so how are we going to solve that? And then you add the issue of
it's not the UK who wants to have a border. I think it's Europe who insists on it, and that's a problem.
Ireland doesn't want the border.
And Ireland shouldn't have a border because
right, they don't want the border, but how do you solve that issue if you're going to...
That's why there's likely to be a...
That's why there's exactly.
I was driving in the city and I listened to the news all morning, and so I'm going to shift the topic. James, I wanted to ask you, how should we, in your view, be thinking about long-term office investing? Now, clearly, and we're focused on Europe, and I was just wondering if you might have a perspective on that, given this sea change or this big shift in terms of what you're doing and the flexibility around space. And I was just wondering if your view is that we should be really thinking differently about the office sector.
So I think you said a key word, flexibility, right? I think flexibility is key, and you're seeing much more blending of spaces. You're having kind of, when you think about designing spaces, you kind of have, besides just these dedicated desks, right? How do you have kind of dedicated space, event space, unused space, kind of space, all these kind of flexible uses of space, which kind of leads to not just kind of leasing, right? So you start thinking, besides leasing your traditional way of getting revenue, but how do you use all these spaces for events, for different monetization methods? So it's really kind of changing your mindset and culture, and not just kind of design a space, but how do you kind of go beyond your traditional methods and have this kind of consumer-facing approach with different ways you can monetize.
And I guess maybe the other panelists, I'm just thinking longer term, how should we be thinking about investing? Is this increasingly a challenge for investors, this shift in how office space is handled, or is it something that we don't have to worry about right now?
I think it's an incremental change. things take a little bit longer than we anticipate because the investment is so high. You know, if you put out several millions into a building, you're not going to rip it out and do something very extreme with it. And one point which I've touched upon and which comes exactly to the topic of flexibility is actually the service office market. And I think investors should be very careful thinking about that element of the market in its impact on the wider office market. I think that in London, in Amsterdam, and in Dublin, it had always very different but very, very marked impact on the market, and there's an oversupply of operators, some of them really good, some of them not, and as soon as the economy turns from its current flourish, I think there will be pretty rapid consolidation, and you'll find yourself exposed to a better or not so good operator. And again, you have to have the asset management in place to do something with the office pretty quickly if the guy fails. Absorption rates and subletting, which inflect rental costs, have been very strongly influenced by serviced offices. So keep that in mind when you go into a market. And when you invest into a building, and that's what we're doing in this Project X that I couldn't show you, we're changing the whole makeup of the building. We're buying it at a very low pound per square foot because it's just grossly underinvested. But we give, from the setup, from the connectivity, from everything else, the future tenants that flexibility that they crave. And we hope that we have a comparative advantage in this, giving tenants on a floor by floor or half floor by half floor the services they would have in a serviced office, but giving us a longer rental contract instead.
Yeah, maybe just to add a few things on this is obviously the word was flexibility, and not just in the way you work within the space, but how you want to keep the space, how you want to pay the space. And I would say that the change, well, it's going to be a long time for sure, but office is drifting in a way like hotel has been changing. So basically, if you remember maybe a long time ago, hotel, you had one manager for the hotel and he was directly in relation with the client. Now you have the owner, you have the operator, and you have the client. And this is exactly how I think offices are going to be because I don't even know what I'm going to do like in 2 months. So how can you expect a company to engage for like 5-year, 10-year, 15-year firm at a rent, even if you have rent review? It's crazy. Everyone wants to be flexible, and the market is so volatile. So you're just maybe, and I totally share this. So I think UK is a great place to invest as of now. West End, the city, it's beautiful. Like everyone is like turning around, like you said. Your client is like, yeah, maybe I should do it, but May on TV was not so good, so I won't do it. Come on, so she was not so good, just do it,
And 2 days later, they called us
exactly.
Have done it.
And maybe in 2 days you're going to say, Britain is dead, the window is dead, now it's Greece. So we need flexibility. So I see the office market turning into, you will still have the big landlords, the big REITs that are going to be running the real estate, but the additional layer that is going to consolidate at some point, because they're burning cash all the way, and at some point someone is going to pay. But there will be this additional layer between the landlord and the tenant to offer that flexibility that the landlord cannot offer. It's impossible for you to manage, to sub-tenants, to manage services. It's not the job of the tenant, it's the job of an operator to do this. So it's more changing within the CBD because, it's easier to do this because, the rents are higher, so you can, have the buffer for the operator, etc. But I would say this change is coming slowly, and so you will have to be careful when not only picking the building, but also picking, the operator is going to manage your building. And I'm not speaking about just property management or facility management, the old way. It's really, like running a hotel. And people and tenants, are going to be willing for all that kind of services, not just a long lease with a rent, and they have to deal with it.
I think things change dramatically, because how we work, how we live, and how we move changes in a dramatic way. So I think people will meet, they want to meet, it's a personal human thing that they want to meet each other for work, for shopping, whatever, entertainment. But that means that you need, and we were entering the German market, and if you see how they pick locations, it is always the best location, because this is where these people want to be. In the beginning was hipsters, now it's more companies, but this is where they want to meet and work, and that is super important. Same for retail. It will work if it's perfect location and entertaining. I'm very skeptical for outskirt offices, retail park, all these things, because you can replace them by not going there, or by agile working, by not going there because you stay home. So I think that is something that's paramount. And that is by the way, closely related to the entire UK-London discussion, because London is such a fantastic city where people just want to be. I don't see Frankfurt, and there as well, so I don't see Frankfurt replacing London to a significant, in a significant way, because people just don't want to be there. They want to be in London. And this is not meant bad. Frankfurt is a nice place, but you cannot by all means compare that with London for the lifestyle, and that's I think more and more important on the long run for the future as well.
I want to take a look at some of the cities, but James, just pick that up, but also how much of this is influenced as well by ideas which have been coming into a lot of the discussions we've had lately, which are what would have been regarded as much softer investment factors, like wellness, like creating healthy spaces, that experience side of it. How important is that as a theme, do you think, that investors should be looking at?
Sure. So I'll try and tie that with kind of the cities real quick. Besides kind of the major cities, right, I think about kind of the second cities. It's easier and easier now than ever to work remotely, right, even with 5G technology coming. And all this is kind of goes down to where the talent is going. So to kind of tie that into that question, it's quality of life is a big topic these days. So quality of life. And so these second cities that kind of, with new buildings, cheaper cost of living, right? You can have a nice quality of life, and that could be where talent flocks, and that could be where investment dollars could go. And to bring it back to kind of the softer kind of points, yes, it's important, but it's this idea is kind of fixed versus flex, right? You kind of, there's a relative standard if you call yourself a luxury building, whatever, to have these things here and there. But with technology these days, right, on demand, you don't necessarily, it's not really a huge factor to retain someone. So how do you, so how do you kind of bring other factors that can be more sticky to that conversation, right? Every building's going to have a gym. That's not really going to differentiate yourself. So how do you build a community? How do you build some stickiness within this building, within this block, to increase, right? Convenience is also, again, key for everything. So how do you convenience of friends, convenience of community? So I think it's those factors that would make a difference.
Okay,
I'll just add something to this, because Guillaume said something very important, and it was just en passant, which many good ideas come out like this. You said that it is very secondary or primary, and it is cost important. And I think the investor will have to make a decision about which space his building wants to live in. You can make really good money in secondary offices that you equip to a comparatively low standard, collect comparatively low rents, and buy at a comparatively low price. That's a secondary strategy, that's perfectly fine. And then there's the other end of it, and that's the prime area, which you mentioned in the CBD, where the building has to be really good, the location has to be really good, the services and amenities have to be really good, and you have to be willing to invest into this building on all these things to keep it up to speed. These are totally different strategies. They demand completely different service. Second one, you're very hands-off. Every 5 years you renew, and that's it. The other one demands probably specialist help for your spaces. And as Guillaume said, these are very different strategies. Both of them can be successful, but you must know what you want with this building, and you must be sure that the location you pick is right for that strategy. And if it's an up-and-coming area like the Meatpacker District 5 years ago, you can go to the upper strategy. If it's La Chapelle, where lots of investment is going in, it's really difficult at the moment, but so much money, it's going to change. Parts of London, that's all where it makes sense, but you want to be sure that when you buy an asset, that you have in the back of your mind what you're going to do with it and in which of those two directions you want to take it.
Yes, a couple of questions, sir.
Yeah, I find it pretty interesting. So I think the trend to flexible offices, I think that has just really started. Because if you look, so we work a lot with mergers, spin-offs, carve-outs. So 5 years ago, like the corporate leaders, nobody was thinking about like going into a flexible office. It comes up now all the time. So it still comes up, but okay, what do we do with this 5, 6, 7 people? But now it also like starting to, okay, we have 50 people. And it's really getting like a lot of, getting more important. Point being is, so we are all real estate investors, right? We know real estate and we know how you make money, but on the corporate side, often it's middle management dealing with like massive like values, with massive spaces. They are just not thinking about real estate in the way that we think. So it just has started. And to the cost perspective, I mean, yes, like if you talk to corporate leaders, they like thinking of rent, right? But then, okay, then you have to build out a space, right? Which is what? It depends on the city, but it's like, can be like, I don't know, $100 per square foot or more, which you also, it's a big like money shell out on day one in, let's say, in the spin-off and the carve-out. And also you need to analyze that over like the leasing time, right? So it's both things. It's like a flexible thing. Companies don't want to like lock into that liability anymore. And also they start realizing it. There are like opportunities out there, and it's also often more cost efficient to go in a flexible office versus like renting a new space. So from my perspective, what we see in the market, it really has just started. And another big trend which is going on right now is this change to the lease accounting change, right? So when you stay below 1 year in your lease term, you don't need to put the lease on the balance sheet, right? Which is also like driving that trend to like going into flexible offices.
Okay, good. Thibaut, you've got a question.
Yeah, one question. You were talking about flexibility, right? So it's quite obviously in the market, but furthermore in the real estate market, it's all a question of cycle and things change. So I was wondering, so in general, you can take any product, for instance, your car. So of course, flexibility is a good thing, but at the end of the day, you can make any calculation in math. At the end, it's more expensive when you get flexibility. So my question is, do you see your clients, investors, now thinking, or maybe seeing more and more owner-occupier, like companies that are just thinking about no more renting the surface, but owning it, from cost perspective? Do you see that trend in the market?
Well, I would say managing a real estate asset is, well, it's costly and it's time consuming on top of cost. So I would say when this company has the real estate knowledge, why not? But what I don't see so often. But maybe to pick up on the two last conversations. The first thing is it's interesting because for Europe, the main tenants for co-working are not, as you could imagine, like teenagers with jeans and just waiting for the free beers at 6 or 5 p.m. 65% of those are big corporates that just put project management over there, and it's just about attracting talents, because basically if you want to have the top people from universities, if you do the 90s style big campus suburban, well, you got the tennis, you got the stadium, you got everything, but you need a car. It's like in the middle of nowhere, and when you're done with your work, whatever that time is, well, you just nowhere. So that's the first thing. And the second thing is that obviously flexibility is more expensive. Everything has a price. But I would say that at the end, when you compare like maybe the footprint that you will have within an operator, could it be directly affiliated to a landlord or whatever, if you can change, the space you want to have like every month or every year, I think, versus being locked in a 10 year or 15 years, whatever the rent reviews that are more obviously favorable to the landlord and not for the tenant, obviously. I think at the end, well, instantaneously you pay more, but at the end you make huge savings, and you keep your employees. I think that's the first thing, because hiring people and placing them in a pretty cool place in the CBD versus I think that beautiful campus. I would say 50 miles away from the center of the city. It's a different kind of thing.
So you've got a question. Oh, there's lots of questions. Okay, let's do one and then.
I just wanted to pick up, and probably James would be able to talk about this. I'm sorry if this has already been asked, but what is the average lease in a co-working space? What does the tenant makeup look like? Because that for me feeds into how the hell do you underwrite reworks and the rest of it?
Correct.
So James first, and then.
Okay. Are there any? I'll tell you what. Well, let's do all of the questions now, and then we'll pick them up in. Because you had one, Monica.
Yeah. It wasn't really a question. It was more of an observation, just watching the market at RCA. And what we've noticed is a lot of interest in secondary offices as a sort of place to put money. And also, I'm very interested in the hotel sector. And again, what we saw last year and the year before was a huge rise in more people being interested in buying hotels, rather than all the prime markets going into more secondary markets where there's higher yield, which is something that Alexander talked about in the beginning. So I think investors have shifted a little bit. I mean, not all of them, but more people are now looking at these secondary locations with a renewed interest and appetite. And I think that's what we've seen, particularly last year, what we'll probably agree.
Okay, good. Yep.
Yeah, the question is for James. Can you give some tangible examples about what your company does to drive value for landlords? Outside, some of these buzzwords like wellness and community, like what are some tangible examples, and if you have stats on incremental revenue streams over time?
Okay, two for you so far, James. Have you got them in mind? Yes.
Yeah, along those lines, it makes sense in terms of new development to repurpose these spaces. But are you seeing the capital actually going into office assets, and how is that cost being transferred into the tenant leases?
Okay, good. James, do you want to pick up the ones for you, and then guys, if you want to pick up the other one, the more general about investment. James.
Sure. So I'll start with this one, and I actually don't have too much insight into that, but I will say, besides the big names that we work, all these co-working names that you hear of, there's a lot of co-working popping up, right? And actually, there's a lot going out of business. So I would just keep that in mind. I actually don't know what the lease terms, but it is interesting to think about how it works for these smaller players. So going on to kind of more specific examples, yeah, I think it's two-way. I think when you think about tech, right, you think about informational and transactional. Real estate, I think it's interesting where there's some areas where we're able to do transactional, right? You think buyers and stuff like that, but we're kind of still informational, kind of like on certain aspects, right? Just kind of running the building and stuff like that. So we're kind of in the phase of getting information on the consumer. So being able to, New York's kind of a great example. You can kind of say, because my building is in this neighborhood, this is probably what my demographics looks like. But actually being able to kind of capture that data a little bit more, figure out what their preferences are. Maybe they don't want coffee, maybe they don't want Starbucks coffee, maybe they want a different brand. So it's these small little preferences that we're trying to think about. How do we curate the experiences within the buildings, but not only building, right? Think convenience, so like within the block. So how do you probably think about, let's maybe not put like a Starbucks here, let's put that different brand of coffee there. Let's put a gym here, and maybe that can replace our gym. And how do you kind of think about your block instead of just a building? So it's this kind of informational phase of how do we start getting data on the users. And a little bit more specifics, kind of, so through our app, so through these 10 experiences, there's in-app purchases. So these are ways to kind of gain revenue besides just leases, right? And it's still work in progress, but how do you kind of have these kind of called revenue shares through purchases in the apps for whatever it may be? Maybe it's more the hotel concierge type service that you can purchase through the app and kind of gain revenue that way.
Okay, good. We've got a relatively short space of time for this panel, so I just want a couple of quick-fire ones, which are, let's look at the cities. We've looked at a lot at London. What about Paris? Just give us a quick kind of view on Paris as an investment opportunity, Guillaume, since you're from Paris.
Yeah, maybe quick one to respect the timing. So, as you may have recalled on the different slide that was shown up, is Paris is basically number 2 on the European shopping list after London, obviously. Because the good thing is Paris is a large market, so even during the downturn, you can flip it pretty easily, I would say. So, if you look back at 2008 and 2009, 2010. Not so much transactions, not so many transactions, but you could at least sell your piece of real estate. I would say the drawbacks of Paris is obviously, as you know, changing regulations. We love that in France. We say one thing one day, the government say one thing one day, and 1 year after, there are people in the streets or there's something to be fixed. So, real estate is easy because flipping a real estate asset, it takes you, I would say, if you're fast, like 5 to 7 months in France. So it's easier to tax real estate than any other product. So you could be careful with that. But Paris, obviously, it's hard to from a global saying to say a resume on that. But there's obviously different markets. But I would say if the main things to have in mind is one, basically markets are everywhere. So and also to answer your questions, basically why you would go to a tier 2 city or country is obviously to get some more yield and potentially get some compression. Honestly, from what I can read in the press, and I think we have the same press, there's not a lot of room for compression. So you have to, as Alexander mentioned, you have to get dirty. You get to take your shirt off and to do some real business to put some value on your assets. So I would suspect as of now, tier 2 in Germany, no problem. And sorry, I'm skipping away from the main question, but we'll come back to it. So as politicians, remember. But because Germany has a strong industry in tier 2 cities, and there's real people doing business over there. It's not just the public administrations getting some office buildings, and the rest of it is like basically nothing. So I would say concentrate on tier 1 location, and obviously Paris is one. But obviously, if you want to step out of the pack, step out of the crowd by queuing up for crazy tender offers where you get 2, 3, 4 rounds and you don't even know who's winning and why is he winning, and at the end, well, the asset is not for sale. Maybe you're looking for more complex assets, still good location, but you have to, one, accept obviously more complexity on the asset deal, so just at the level of the asset, obviously, so technical, leasing, legal claims, stuff like this, and also keeping the discipline is, because I think this year will be really interesting, especially in London, Paris, or even in the US, because there's, we have to admit it, there's a lot of money, there's too much money, I would say. Then how are you going to spend the money? So the core part is willing to do core plus because they want to get a little bit more value. And the value add opportunistic, well, they can find the big products, so either they go corporate or they buy platforms, but they don't have not a lot of platforms, so they go core plus. So basically everyone is getting back on the kind of core plus, and for me, I can't define core plus. I don't know what this is, The only thing you can do is either you can do core, so basically you're paying beautiful asset and you're just getting the return for long term, easy to assess. But on the other hand, you're positioning yourself on a, I would say, manage to core obsolete building when you know what you're going to do and where the value is going to be. But in between is basically, well, I get a little bit of return and potentially I will have some reversion. But when you see what's going on, today, the 5 to 7 year window is like really hard to read into. So I would say, tier 2, well, I won't go this way, but mainly, tier 1 and obviously, London, Paris, but, accept more complexity on the asset and, keep the discipline. So if you core, you stay core, you do little couples because it's a different business. And if you're value add opportunistic, well, you're good at like reshaping the building and turning them around. So don't think that core plus will be easy. It's, let's stay in, obviously what you can do.
Just quickly, Carsten, because obviously Germany, very federal system, but Berlin's suddenly been growing hugely in terms of investment. What's the situation there? Is that a good opportunity at the moment?
I would say as the vast majority of the Germans, I didn't see that coming, to be very honest. This is probably due to the 90s where there was a boom already and people were really skeptical that this can be another boom. So yes, as the Germans, I didn't see it coming. Does that have a perspective? I think there's two things. There's this one dimension, and that could be on the long run, the decision-making driver is that this is the only German city that has the capacity to become a London-Paris alternative on the long run. It's not there yet, by far not, because the companies are elsewhere. They are in Munich, they are in Hamburg, their banks are in Frankfurt. So there is a bit of tech, and it's art, cool restaurants, and a big hype. However, it is changing. It is now in certain parts the most international city in Germany, so you can get around speaking English. It has the potential, yes, and if someone invents something there in the IT space, tech space, that can change things, yes, I would be careful on the long run though, because the high rents that you see now for prime spaces are due to the lack of prime spaces. But there is development coming, so I think on the long run, on the very long run, yes. On the midterm, I would be skeptical because I don't see any German company moving there. So it is that, I mean, the car producers could do something. They have a tech lab or whatever lab in Berlin. Then the banks, they could move. They don't do it. So if they get it turned around, it's the game changer for, I think, not only Germany but CEE as a whole, basically. Because if you see where Berlin is located, it's closer to Poland than to Brussels. So that might change geographies on the long run, but I mean, it very much depends on your horizon in terms of the investment. If you're talking 5 years, I would be scared.
I think we haven't answered Zoe's question and maybe Thierry's. If you allow, I'll just attempt. Thierry said, very interestingly, flexibility is more expensive. And you said, how do I underwrite WeWork? And I think it's all the same answer. And without being flippant, I would like to take your answer, flexibility is more expensive. You meant it for the tenant and turn it around for the landlord as well. If you have a flexible office provider, it will have, in most cases, an impact on your net initial yield of your investment. So it'll trade probably lower. It'll cost you a lot to fit it out for them, so your investment will be higher. Financing will be more difficult because we, for our clients, try to finance several offices with serviced office providers. We got them all away, but I tell you, there were several banks that simply said, no, we have enough of that, we don't want anymore. And we said, but it's a good location, and they said, it's all very nice. Tenant is for us important. This tenant we have either overexposure, we don't want them, we don't want that. So your financing costs are going to go up. So overall, it's going to be a little bit difficult. And then you add to this that most of them are very difficult to underwrite, because if you look at Regis, who had a fantastic American empire, went into chapter 11 just to stay alive in Europe. And there were several investors and landlords in Europe who had large exposure to Regis and said, right, now we can do one thing. We can tell them, you failed all your covenants, you'll have to go. And then we have empty space in the middle of a recession. That's not a surefire way to prove to my investment committee that that was a good investment. Or we're going to give you big rent discounts, standstills, and Thierry is nodding. There were several banks who then also had to make concessions because it fell on banks who had exposure, and the interest payments were a little bit short at that point in time. So the service office market letting long and subletting short, that could be expensive not only for the operator and the user, but also for the investor. So think about it, where you use it and what you accept.
Okay, good.
Okay, just so furthermore, the image of your building on the market, also as an owner, versus how it could be perceived by the tenants. Because, for instance, we can see, so on the lending side, but if we can see, for instance, in some leases, which is kind of we work with maybe it's like they said, okay, so you, for instance, release 100% of the building, but if tomorrow, and you pay the rent. If tomorrow the building is, for instance, 50% occupied, then I'm allowed you to keep your house. But I don't want to see my building ownership in the rent 50% lease, because maybe the other tenants will think that it's not a good building. So it's interesting also to see the impact on the image of the building itself, which is quite important as well.
Just to keep us on track on time, I've got a quick one, which is for those who are, James, you can skip out of this one. But just in terms of where people should look to invest, where do you see the biggest opportunities at the moment if you're looking at Europe? Let's start with you, Guillaume.
Well, as I'm going to stick with what I said, hopefully. So I would say tier one locations, so mainly cities. So just to quote some example, obviously London, Paris, German cities, but going to assets that are like we mentioned, that are complex. So technical issues, leasing issues, claim on the building, but still proper location, because at the end of the day, when you clean all that mess, this will be a proper product for a long-term investor, insurance company, and also, if I'm more working on the value add section, is I think the most important thing is to keep the discipline, because if you lose the discipline and you say, well, we're looking for mid-teens return, let's go down to 9, because it's hard to find it. It's not the way that when you're looking for value, you need to find asset that needs value creation, because you're not going to find this value in less yieldy, I would say, buildings. So yeah.
Okay, good, Carsten.
Tier places, but my warning is that the real estate industry could be the German car industry before diesel. So very successful, but a bit arrogant. So we are, I think, over the last 10 years, we're overly successful, and that can be proven wrong. So I think you need to focus on your product, good real estate, that you operate well, that looks nice, and that people really want. And I think that last thing is something I don't really see in the market, because there's buildings, resi, for example, there's things being built that are as ugly as they can be, but they still sell. And I think that is the danger there.
Okay, good. Alexander.
4 steps, very simple. Go to a country you're confident in that it is a strong and stable market. Otherwise, it's just not worth it. Secondly, it has been said already, be realistic what you shoot for. If you want something that the market can't deliver, you will be disappointed, no question about that. Be very disciplined in what you do, in executing your strategy, and only go into complex assets if you have the right partner with you. Otherwise, it will land on your lap and it will end in tears. Then you can make money in quite a lot of markets.
Yeah, I can just quickly add, so Sweden has been a nice market for us. So I think, just if you are interested in the kind of community and the kind of market, I would think a little bit about the culture of I think European culture is pretty collaborative in the community in general, right? But I think Sweden does have generally accepted kind of a big culture on community and everything. So maybe think a little bit about that. What cultures actually make sense to kind of have this kind of co-community and co-living style in there.
Okay, that's great. Thank you.